But today's episode, I want to deal with this area of finance, the finance section. Now, as you know, for the last few episodes, we've been looking at the 8 key areas of business, and we break those down through planning, leadership, sales, marketing, people operations, finance, and legal. And I've been having various team members from our organization come on and talk through the various sections that we track internally. Part of my mission this year was to nail down the tracking mechanisms for all 8 key areas of our business. And when you get to the area of finance, just like all other areas, we have key results indicators, we have performance indicators, and we have key performance indicators. So the finance department has a ton of indicators that can be tracked. In fact, we're tracking just over 40 indicators total within our finance department. Whenever I was talking with the team about who wanted to speak on this matter, everyone said, Justin, you are the man on this. This is your area. And I got to tell you, I love diving deep into the financial reporting of businesses. Whenever we meet with business owners, one of the things that I ask for is updated financials every time we meet. Now, we typically meet with business owners on a monthly basis. We have clients that engage us for monthly consulting. And then we have a 2-1 model where one of my team members, myself, or somebody else would meet 2 times with a business manager and then 1 time a month with the business owner. And in those meetings with the business owners, we want to see the most up-to-date financial reporting. So typically it's income statements. You might refer to them as profit and loss statements, and balance sheets. We want to see the numbers. What are the numbers telling us? And in our own business, in Heritage Investors, Heritage Business Advisors, and Financially Simple, 3 businesses kind of working together as one, we look at some of the same things that you would look at. We look at past, present, and future indicators. So for example, a present indicator may be budget variance. What did we actually spend and make versus what we projected? So present would be a budget variance type of an indicator. If I'm looking backwards, it may be revenue growth. What did our revenue growth, what was the trend on that? What is our net operating income growth over time? What's our profit margin growth? Those are a few indicators we might look backwards on and see how it's performed. And then if we're looking to the future, we're going to forecast out through our pro forma, we're going to forecast out what is the future revenue. That's an example. What's the future expenses? What strategic expenses might we have in the future that we need to start planning for? So just like your business, our business is looking at past, present, and future indicators. But if I had to nail it down to 1 indicator, or 2 indicators, let's go over 2. If I had to deal with 2 indicators that I believe are important to our company, our particular company, I would start with revenue versus forecasted. Revenue versus forecasted. So that's an indicator that we track. And what's being tracked is the total revenue and the predicted number of clients multiplied by the average deal size, which is our forecasted revenue. So how this works is we know in our business what we're slated to make over the next quarter. We can look forward a quarter and kind of just based with contracts, based on what we're working on, what we can expect. So as we're planning forward, we may say, you know what, we have, I'm just going to make a number up, 10 clients this month that we're working with. Next month, we want it to be 12. And we want those 2 extra clients to have an increase of 20% over our current costs or our current revenue. So we can look at the revenue that we're forecasting. So we want to forecast out what we think we're going to have, and then we want to check and see do we actually meet it. So that's what's being tracked. Now, why is it being tracked? It's because it is the livelihood of our business. We track it so we can manage our operations effectively. In our business, whenever we gain a client, we have to do a ton of work, a lot of work within the first 90 to 120 days. So in order for me to handle the flow, I've got to have the people, the team, prepared to handle taking on a new client. If all of a sudden we weren't managing the onboarding of new clients in our company properly, we may be in a position where we don't have the team members to be able to service the clients that we've engaged. So the reason why we track revenue versus forecasted is so we know how to plan on when do we need to hire an associate, when do we need to bring on another senior planner, when do we need to bring on some outside consultants to help in various areas. So we track it so we can know how to manage our business. Now, who tracks it is myself and our CFO. Our operations department, Miss Amy Aarons, you're going to hear from her in the coming up episodes. She helps me track this various types of information. Where do we track it is through a system called QuickBooks. We use QuickBooks, but then we program in this extra subscription called Fathom, Fathom. If you're a QuickBooks user, there we go, QuickBooks user, then you can add Fathom. It's not that costly, but it's a KPI reporting dashboard for your business. So we use QuickBooks and Fathom. Actually, we have an outside CPA who handles all of our books and does our audited financial statements for us. When do we track this information? Well, we track it weekly. Weekly, yes. Every week, I want to be able to see where is our current revenue in projection to our forecasted revenue. Now, we can break it down to monthly and quarterly. We can even go to annual if we wanted to, but I like to look at this weekly because it helps me determine where's our business moving toward. So it's tracked in QuickBooks. So that's one indicator that we use within our company, revenue versus forecasted revenue. Another indicator that we track is profit margin percentage. What is our percentage of profit margin? So what is that? Or what is this being tracked? We're trying to see, take your income minus your expenses, that gives you your profit margin, and then we want our profit margin to be as close or exceeding 20%. We want ours to be 20% or greater. So it is net income is what we're looking for. What is the net income? Well, why is it being tracked? It's because we're tracking it to meet our long-term desired goals. See, I have this vision in my own mind that the company should be owned by employees. I believe that. I think the team should own the company. You say, well, Justin, I disagree. That's fine. In our business, it's not uncommon for planners to own the company. It's not uncommon for a company to kind of marry alongside a little bit bigger company, gain scalability. So I want our team to be able to participate in this. In order for that to happen, we have to run a company that has a 20% profit margin. That is above all operating expenses. That's above owner's basic salary draws. That's above everything. So we want to see a 20% profit margin. So who tracks it? I do, and our CFO, Miss Amy. The two of us work on this consistently. Every quarter we have to track it because it goes into our bonus structure within our team. So we have to track our profit margin percentage. Now, do you always hit 20%? No. Sometimes you make tactical investments. We're going to talk about some other indicators you can use. But sometimes we make tactical investments in the business, knowing that maybe a quarter or two, we're going to be well beneath our 20% profit margin. But we can constantly know and look in our projections of, are we meeting our 20% profit margin objective? And how do we track it? Once again, it's done through our accounting software. Again, our CPA uses QuickBooks, and we use Fathom, which is a plug-in to QuickBooks that you can utilize. Now, it's often asked of me, Justin, are there any unique KPIs in the finance department that Heritage would track over any other business? I really don't think so. I really don't think so. I've looked at all of our KPIs, and as we consult with business owners all across our nation, trying to help them grow their business so they can reach sellable value, so we can, as I say, try to teach them that you can double your net worth every 3 to 5 years as a business owner. We do this consistently, and as I'm diving into the numbers, helping business owners set up these tracking mechanisms, I see pretty much that business is business. Business is business. Now, there are a couple of nuances when you get into operations or hiring people, but when it comes to the financial side, business is pretty much business. There may be a slight variation on one of the ways you would track something, but for us at Heritage, it's not much different than the clients that we have the honor and privilege to serve and walk alongside as they're trying to reach their goals and drive their net worth. So that leads me down to, Justin, if I had to track 5 different indicators for your company, Heritage, what would they be? So, like I said, we track just over 40 indicators in the finance department, but these 5 are the ones that I feel like make the most sense for me to kind of hold my pulse on, hold my finger on with our company. The first one is what's called EBIT growth, earnings before interest and taxes, EBIT growth. And it's designed to measure the percentage of change of EBIT during a period. It's a combination of growth in revenues and growth in profits. So it's a way that you can balance, you can measure the balance of your company. So you want to see your revenues grow. You want to see your expenses kind of hold tight or not grow to the same term as your revenues, and allows you to look at what the trend is in the organization. So EBIT is earnings before interest and taxes. Are my earnings moving in the right direction? Are my earnings moving? Another one that we track that kind of coincides with that is revenue growth. Revenue growth. Revenue would be top line income. They could be almost the same thing. I like to track EBIT. Sometimes I shift it over to EBITDA, earnings before interest, tax, depreciation, amortization. EBIT and EBITDA are what's used in our business for valuation purposes in the finance area that we work in. So if I were going to sell a percentage of the company to team members or to an outside strategic alliance, they would look at EBIT. But for my simple mind, I want to see the revenue growth. I want to see what is my top line revenue. Now, on our company, I separate the revenue trends, and I teach business owners to do this as well, into the major areas of revenue. So we get paid a couple of different ways. We get paid through financial planning fees. That's basically we charge for our time to construct financial plans. We get paid for business consulting. We get paid to manage money for people. We get paid to work in employer-sponsored plans. Financially Simple drives revenue to our company through book sales and speaking and things of that nature. So I like to look at my revenue and see each of those segments of our company and then track the revenue growth of each of those segments. So EBIT would be all of them together. Revenue growth is isolating each of those market segments so I can see which division or which revenue stream of our company had the greatest revenue. So those are, they sound the same, but I separate them because it allows me to see what is the pulse, what's happening in our company, not only from a total revenue standpoint, but also from a disposition standpoint. Remember, I'm always building a business to exit. And that's the same thing you should be doing. You should always be building a business to exit. If you don't know how to do this, friends, this is what we do. And we're pretty doggone good at it. We've gotten lots of, we've received some national awards because of our abilities in this area, because of the influence that I have through Financially Simple. Things like Investopedia's Top 100. You can read all about that and the various awards on the website. The third thing that I think that is important for us to track as business owners is what's called return on equity. Return on equity. You know, oftentimes business owners think, and I've got to be honest with you, I'm guilty of this myself, we think that our business is the best asset out there, that we can make more money than Wall Street. We can make more money than even real estate sometimes. But yet we really don't know how much money we make. We really don't know what the return on our equity is. So return on equity is one of those areas that I feel like business owners really need to get a handle on. It measures how effectively the business is using the resources that the owners have given to generate profits. So let me see if I can illustrate this simplicity. If your business, if you used $100,000 to start your business, or that you used to create equity in your business, then we want to see what the ratio is, the return on that equity is for you as a shareholder or a member if you're an LLC, taxed as a partnership. So basically this is like the stock appreciation value, okay? If your stock that you put in was originally $10 a share and now you're at $12 a share and you've had your business for 10 years, then your return on equity is not very good. You'd have probably been better off taking your dollars and putting it over into an investment account somewhere or into a different type of an investment. So one of the things I like to look at as for business owners and myself is what is the return on my equity? You know, small businesses, because we have so much risk, we should be able to get a higher return. I know if I look at various charts, and I'm not going to cite any specific charts here. It's common knowledge that, the large cap growth area out there, S&P 500 might say, but depending on what time frame you look at, you might anticipate an 8, 9, 10% growth on that. The small cap market may be 10, 11, 12% growth over a long period of time. Now, again, there's various charts you can look at, but if you use Dave Ramsey's number, he says, hey, I get a 12% return using a good growth mutual fund, right? So you can use whatever number you want to be there. I think sometimes those are aggressive. I like to plan, if we're dealing with 100% equities, I like to plan on 8% growth. But those are big companies. Those are companies that follow Sarbanes-Oxley Act, things of that nature, that have, they have some risk, but compared to our small businesses, not near as high of risk. So our small businesses should have a return on equity far in excess of what we could take our own dollars and invest in the stock market or buy a good mutual fund or ETF or whatever it would be that your advisor would have you buy. So if we're looking at return on equity, we really have to look at, we gave in X number of dollars to start our business, and now here is the return that we're getting. You say, well, Justin, I got a great income. Just because you have a great income doesn't mean you have a great return on equity. If you don't know how all this works, again, reach out to us. This is what we do. The fourth thing I like to look at is the return on capital employed. Return on capital employed. You've heard the saying, in order to make money, you have to spend money. We've heard that. In fact, you may even say it to yourself. I heard people recently say, sometimes the bear gets you, sometimes you get the bear. I don't necessarily agree with that one, but whenever I'm looking at return on my capital that I've employed, I want to see a reasonable return. So let's say, for example, that I wanted to make a strategic move in our company and I were going to put $100,000 of my money into the company as a contributed capital. Maybe I would contribute some money to the company because we're a partnership LLC. What is the return? What will that money return me? So whenever I invest in something, we want it to produce additional income, which should drive more revenue to the top line. We may have additional expenses, but then we're going to see our net revenue. If I put $100,000 in, I would hope to get more than $100,000 back out of it so I could have a return on my capital employed. We often see this when we make capital investments in pieces of equipment. It's not uncommon for, let's say, a dentist to call me and say, hey, Justin, I need to buy this new scanner. It's a $35,000 purchase. What are your thoughts? And so we run the numbers and see, does this make sense? We run what's called a hurdle rate. All these things come into return on capital employed. That is one of the various things that I think we business owners often miss. We get going nonstop and we don't have our strategic plan in place and we pour money into our company, but we never track the actual true return on the capital that we've employed. So that kind of works hand in hand with return of equity. And then finally, I'll give you this one as one that I believe we should be tracking. That is budget variance. I mentioned that one earlier in the episode. Budget variance. Now, first you're going to assume that you have a budget in order to check variance. So one of the things we do every year that I've been doing for years now is building a budget and then incorporating the budget into a pro forma. So I can see, okay, if we hit this budget, here's what the company should be, and here's how I can plan going forward. One of the things that we track in order to meet our bonus expectations with our company is we outline a budget. We know what it should be for each quarter. And then the expenses, we have a good idea on what expenses are, but you know how business works. Before you know it, you have a computer go down, you have a piece of equipment. Actually, I had a client not too long ago that a piece of equipment rolled over and caught the motor on fire. $15,000 unexpected expense. So that could cause your budget to be out of whack in a quarter. So one of the things I want to look at is, what is my budget variance? I have my budget in place. How did I do? How close did I come to keeping my expenses in line? And was my revenue about or lower or greater than I expected? So if I were to give you 5 things that I think every business owner should track when it comes to the finance area, it would be EBIT growth, revenue growth by division, return on equity, return on your capital that you employ, and budget variance. Those are 5 pretty important indicators. And you say, Justin, I have no idea what you're talking about. You've lost me. This is why people hire us, because we can help design a company that doesn't require me, the business owner, or you, the business owner, to be there every waking moment. I was thinking as I was dealing with COVID, laying on my back for this 2.5 weeks, that I was literally out of the office unexpected. Wasn't planned. And I was sitting there going, man, I am so grateful and I'm so humbled. I'm so thankful to work with a rock star team that's all working in the same direction, that literally signed new customers up while I was gone, that I don't even know who they are. They were able to make up for my inabilities to be there, and the company met its expectations. That is why these 5 things are so important, friends. So you say, Justin, I don't know how to do this. Then reach out to us. This is what we do. This is how we can grow a company. You often say, yeah, you can double your net worth every 3 to 5 years. You can. It is possible. Now, it's hard. Not everybody's going to do this, but you can. And one of the ways that you start off with is by outlining the things that you want to track. Remember, if you can measure it, you can improve it. If you're not measuring it, you're not going to improve it. So friends, that's this week's episode. I hope that gives you some insight into how we run our company a little bit, and hopefully you'll be able to use some of this information to rock it out in your own business. Look, I realize life is hard. It is, but life is good. We are so blessed. We are blessed beyond measure. And it can be frustrating sometimes. Trust me, I did not plan on taking 2.5 weeks off. It can be frustrating sometimes, but at least we can make our lives financially simple. Y'all make it a great week.